Investing in leveraged ETFs versus standard index funds. The short answer is it depends on your tolerance for risk and your understanding of how leveraged ETFs work. Leveraged ETFs like SPXE aim to amplify the returns of an index on a daily basis. So if you're considering a 3x S&P leveraged ETF, it's designed to deliver triple the daily performance of the S&P 500. This sounds fantastic when the market is charging ahead like a bull in Pamplona, but there's significant risk involved. Let's break down some of the key considerations. Volatility and decay. Leveraged ETFs experience something called volatility decay. Here's a simple explanation. If the S&P 500 goes up 5% one day and then drops 5% the next, it will be slightly below where it started. But due to the triple leverage, your 3x leveraged ETF would be more than slightly below. It would be significantly below, because the losses are also tripled, and they compound in a way that's not actually symmetrical with the gains. The long haul. These leveraged ETFs are typically not meant to be held for the long term. They're often used by traders who wish to bet on short-term movements. Holding a leveraged ETF like SPXI for 30 years exposes you to an extreme level of risk and uncertainty. They're calibrated daily, meaning the leverage resets every day. Over the long term, this could either be a windfall or a catastrophic blow to your capital, depending on market performance. The power of compounding. Now let's talk about the magic of compound interest with a standard S&P index fund like VFINX. They're designed for the long game. They are much less volatile and offer steady returns that compound over time. They don't promise the excitement of a leveraged ETF, but excitement isn't always your friend when it comes to investing. Costs and management fees. Additionally, leveraged ETFs generally have higher expense ratios than standard index funds. This means more of your potential profit is eaten up by costs. So, what's the verdict for a Portlander looking to make a smart choice for a 30-year investment horizon? If you're going conventional and looking to build wealth with reliability, the Vanguard S&P Index Fund is the way to go. Classic, like the iconic Portland International Rose Test Garden. It's not going to shock you with rapid growth overnight, but it's there for the long haul, like the steady rain we're all too familiar with. Leveraged ETFs, on the other hand, are more like trying to bike down Hawthorne Boulevard during rush hour. Thrilling, potentially rewarding, but fraught with the possibility of a wipeout. Before making any investment decision, consider speaking with a financial advisor to assess your individual situation. Remember, when it comes to investing, sometimes slow and steady does win the race.